So we'll go ahead and start the presentation. Again, everybody, welcome. Traction Financial Partners webinar, Maintaining a Long-Term Focus. We wanted to make sure that we're staying in touch with our clients and friends, letting everybody know what we are following and tracking and thinking about when it comes to the markets. I know this year's been volatile. There's a lot in the news. There's a lot going on in the economy, and we are going to tackle a lot of that here today. But the title, Maintaining a Long-Term Focus, is key because, as you'll see throughout the presentation, volatility is normal when investing in the market. And if you maintain a long-term focus, then we always get through these. We always get through the bad times and the choppiness. Each one can provide a different twist, but there's lots of different factors playing into it, from interest rates to inflation, supply chain issues. We got a midterm election coming up. All of those factors we'll address here. But one thing that we at Traction want to make sure that we're focused on for our clients is the fundamentals. Okay? And when we're focusing on the fundamentals of the market, that helps kind of avoid some of the noise that we see out there. Investing can be very emotional. You can see consumer sentiment reports of how people are feeling about the economy, about the markets. There's expectations that are set based on what we think is going to come in terms of policy changes, those types of things. Obviously, you get emotional about geopolitical events when you get a Ukraine and Russia type of conflict. But when we focus on the fundamentals, we look at consumer price index, wage growth, retail sales, housing, that type of stuff. It helps kind of clear things up and maintain our focus on what the fundamentals of the market and the economy are showing us. And one of those that we really like to focus on is earnings. Company earnings drive the market. This slide here, on the left-hand side, you can see the S&P 500. On the right axis is the S&P earnings per share. How are corporations showing earnings? Are we still making money? When you invest in a company, you're investing to make money along with the corporation who needs to be posting earnings, making profit. And when you look historically at the S&P 500 and how it's performed, it really has tracked earnings per share pretty closely. I mean, it's not exact. You can see the earnings per share jumps around more so than the S&P 500. But overall, the market is priced based on how the corporations are earning. And so when we jump to the next slide, how are we earning today? How are we earning in 2022? That's something that's actually been a positive. Again, we will get into a lot of the other aspects of the economy and the market that have driven the volatility and the pullback so far this year. But something that could help hold the market where it's at or start the recovery would be earnings. Okay, so this slide is showing first quarter earnings for this year. It's incredible. We're actually almost through the second quarter, but the first quarter earnings were actually pretty impressive, given all that's going on, with inflation, interest rates, what the Fed's doing, all those different aspects. Corporations have been fairly resilient. When you look at revenue growth for the first quarter, now this isn't all the corporations posting. This is about 90% of them, I believe, through May 6th. But earnings growth of about 13%. You see that companies beat their estimates at about 74%. Okay, companies beating earnings, 79% have beat their earnings, and earnings per share growth at about 9%. Now this is getting a little technical, but what this is showing is that corporations are still being resilient given all the cost pressures that are being thrown their way, whether it's from the cost of labor going up, inflation, and services.
Sorry to interrupt. I don't think that the slides are showing correctly. There we go. Now it's moving. It was just on the title page.
Oh, apologize for that. Let's pop back real quick to our company earnings. Do you see a graph, Katie?
Yep. Now it's showing correctly. Yep.
Okay. So this is the graph that we were just referencing. I apologize for the delay on that. This one's showing the S&P and earnings kind of going hand in hand along the way. And let's jump back forward to the graph I was just showing, or the chart. Okay, one more time, Katie, just want to confirm, is this do you see the kind of the gears page?
Yep.
Okay. All right, so this is what I was just referencing. Again, earnings have been resilient. Corporations are hanging in there. One thing to keep in mind, though, is that this is backwards looking. When we think about earnings estimates going forward, or when you think of guidance, so when a corporation reports their earnings, they say, here's what we did in the first quarter. Also, we hear from the corporate management, they say, okay, based on economic conditions, sales projections, those types of things, here's our guidance going forward. So a lot of times you can see a company post strong earnings. I mean, if you look this morning, Microsoft had solid earnings for the first quarter of 2022. Stock took a little bit of a hit today. That's because their forward-looking guidance, what they're expecting going forward, actually was a little bit concerning. They had some language in there saying that we're going to be a little cautious. So actually the stock dropped. So corporate earnings, again, good to see that these are showing on a positive. Guidance going forward has been a little bit of a mixed bag because of inflation and other things. For the most part, corporate guidance for the second quarter is still looking pretty positive. But that's something that we're watching really closely because, again, from a fundamental of something that we focus on, earnings is a big one. All right, we just switched to the next slide. So if that didn't update, someone jump on and let me know. But again, we're going to talk a lot about volatility today and staying in the market, maintaining a long-term focus. This slide, I think, really kind of.
Evan, we're still seeing the quarterly earnings.
Okay. How about now?
Yep, there we go. The cost of panicking at the top.
Cost of panicking. I apologize. Yep. I'm not sure why it's lagging like that. So we'll make sure when we switch, we'll just, Katie, you can be our checkpoint there.
Sounds good.
All right. Cost of panicking. Very top piece here, diversification and the average investor. Okay. When we talk about diversification, how that can minimize some of the risk you have in your portfolio, this whether you're an aggressive investor who's going to be 100% in stocks, we have a long time horizon on our hand, very bullish on the market, whatever that might be when it comes to being an aggressive investor, that doesn't mean you can't be diversified. Okay, so one thing that we focus on here a lot is making sure we have diversification in different asset classes, maybe trying to find a few sectors of the economy that might perform well based on economic conditions, but diversification is important and something that we strongly believe in. When you look at the graph at the top here, this is going back to February of 2020. So this just provides an example of how different portfolios would have performed during the lockdown and forced recession of 2020. Okay, so on the far left-hand side of that upper graph, we have February 19th. That's when the S&P peaked. Okay, that's right about the time we were saying, okay, we got COVID hysteria popping up. We're about to lock down the economy, and then you can see as we move forward from there. About a month later, almost exactly a month later, the S&P hits its bottom. Okay. That was about a 34% drop from the peak to the trough. We had the fastest drop in history, 34% drop. Well, at the time, that was something that was pretty unprecedented, where we say, hey, we're on purpose going to lock down the economy. We're going to shut things down. Don't really know what's going to happen. That's a pretty scary deal. So if you panic and get out of the stock market at that point, I can understand it from an emotional perspective. We didn't know what was happening. But as you can see on the graph, as we move forward here, different portfolios actually recovering in the same year, despite a 34% drop in the S&P 500. A portfolio that was made up of 40% stocks, the S&P 500, and 60% in bonds, just high quality US bonds. By June 8th, we would have recovered. Okay, so that just basic diversification between having stocks and bonds, you can see how that helped on the downside, and we got the recovery going back by June 8th. A 60-40 portfolio by July 20th, 60% stock, 40% bond. By July 20th, we had recovered. Okay, and even the S&P 500, if you were just in the 500 largest companies in the U.S., by August 10th, you would have recovered all of your losses, and then you can see how the chart off to the right starts making money. So just again, to hammer home the point that if we keep a long-term focus in mind, panicking at the bottom is usually the worst thing to do. We want to make sure we kind of stick through it. If there's changes to be made based on, again, that long-term focus in mind that we think might benefit us as it recovers, we'll do things like that. But the best thing to do is to make sure that we don't panic and to keep that long-term focus. At the bottom of the screen, there's a 20-year annualized return by different asset classes. Okay, so from 2002 through last year, this shows the annualized return for different asset classes. And we're not going to cover all of them, but there's a couple that stand out here. One, the first one is REITs. So real estate investment trust has done the best over the last 20 years. That includes a pretty rough time during 2008, right? So REITs have really done well. We've actually added those to most of our portfolios and our models on the more aggressive side of things, because during inflationary times, even during recessions, REITs tend to do well. The third one in S&P 500 over the last 20 years, 9.5% per year. And you can kind of see as we go down to the right, the fourth one from the right-hand side, you see the average investor. The average investor return since 2002, about 3.6% a year. Okay, and why we want to make sure that we pointed that out is this is the cost of panicking. When the market's going south, it's natural just to want to say, I don't want to lose anymore. I'm going to cut my losses. I'm going to get out now. Well, the problem with getting out is you got to get back in. And when are you going to time that? Most folks wait too long. The market's recovered or has recovered much of its losses, and you miss out on the recovery. That's the cost. It costs directly to your return, 3.6% a year since 2002. The average investor has lagged behind the S&P by a lot, and a lot of these other asset classes. Going to jump to the next page. It should say volatility should be expected. Okay.
Yeah,
Katie,
it's showing.
Okay, great. A lot of you have seen this. This is my favorite chart. I love this because it really puts in perspective that volatility is normal. It's not comfortable. We don't like to see volatility, but volatility is a normal part of investing. Okay, so going back to 1980, the average intra-year drop on the S&P 500. You can see a line at about 14% running across the middle of the page there. On average, we see a 14% drop each year since 1980. Now, that's not from the beginning of the year, that's from the peak. So throughout the year, the average drops around 14%. A correction is 10%. So a 10% correction on the S&P 500 happens every year. On average, not every year if you look at the chart here, but on average you see a correction. Okay, a bear market is a 20% drop from the peak. You've probably heard the bear market a lot this year in the media. If you're watching the news, they'll talk about bear market. Bear market's a 20% drop. We haven't closed at a bear market, but the S&P 500 has been there in 2022 a couple of times. So just wanted to talk about correction and bear market there, just so we know the terminology, 10% and 20%, but the average drop intra-year since 1980 is 14%. If you look, the dark, I believe it's dark blue, bars, about 75% of the time end the year positive. Okay, a recent one, if you look, go to 2020 on the right-hand side of the chart. Again, we just mentioned this, a 34% drop in basically a 1-month time period in 2020. The market ended up close to 20% that year. Okay, so again, if we panic and got out at the bottom, not only did you miss recovery getting back to flat, you missed out on an additional close to 20% return. Okay, so this is stay invested, don't panic, keep a long-term focus in mind. Love this chart. If there's any questions, again, type them into the chat. I'm going to let Drew take the next 4 slides. Okay, so again, Katie, if you can make sure that we're switching the slides here, that would be great. I'm going to move the camera over to Drew.
All right, thank you very much, Evan. So we should now be looking at a slide saying market timing is a losing bet. So please let me know if we're not seeing that. Okay, great. To really just further hit on the point that investing is to build wealth and to be utilized to meet your goals, right? That's what we want our money to be doing. We want it to work for us so that we can meet our goals. And so as an investor, trying to time the market is nearly impossible. You have the smartest investors in the world, PhDs, no one can consistently time the market, period. So what this chart's showing us here is that if you're just fully invested, and this goes back to 1990, so about a 31-year period, if you're fully invested in the S&P 500 over that period, and you just kind of rode the roller coaster, didn't make any moves when it was up or when it was down, you're averaging about 10% a year. So, and if you look back even further, going back close to 100 years, the S&P is right at about 10%. So it's if you're following the news every day, they'll say, wow, Dow down 1,000 points, fell 2.5%. But what they don't say is, and the long-term average still remains at 10%. So if you remain invested and you don't panic when things get low, you're getting about 10% a year in just a diversified S&P 500 fund. If you miss just the single best day in the market in any given year, at least here over the last 31 years, you're giving up close to 4%. You're getting about 6% that year. Naturally, it's because the best day generally is about a 4% rise in the market. If you miss the 2 best days, 3%. So you've cut your return by 7% just by missing the 2 best days that the market has to offer in any given year. And now at best, you're probably matching inflation. You miss the 3 best days, you're pretty much flat. You didn't really make any money. So now you're losing to inflation. And when inflation is running higher like it is now, that really is a big sting when the market's up 10%, but you got 0% because you missed the 3 best days. And then just continuing on down the line, you missed the 5 best days. That's just one trading week, Monday through Friday. You missed the 5 best days, you lose 4% that year. You missed the 10 best days, you lose 12.5% roughly. You missed the 20 best days, you just created your own bear market in and of itself. You're down 24.5% nearly. So as Evan mentioned earlier, when you're trying to market time, you have to know when to get out. You have to know when to get back in. And then you have to do that every single time. And as he said, most people are far too late. When it feels better to get back in the market, it's probably because the market's recovered. So the ship has already sailed. You've missed that comeback. So the key here is If you maintain that long-term focus, we all kind of understand the concept of higher risk, higher return. If you maintain that long-term focus, you've 100% of the time been rewarded in the U.S. stock market. You know, we kind of like to say it's like a man doing a yo-yo hiking up a mountain. If you're focused on the yo-yo, you might get a little dizzy, you might get a little sick. But if you just take a step back and focus on the long-term trajectory, it's always been up and you've always been rewarded for remaining invested. So just to kind of put this in further context, it's a common phrase in our industry, time in the market, not timing the market. Time in the market is what wins. If you look at a 1-year average here, and I'm assuming that we're on the right page here because no one's chimed in, so chime in if we're not. 74% of the time going back to 1950, the S&P 500 is positive. I think if we gave everyone $1,000 and said go up to Blackhawk and you're going to have 74% odds, I think we'd all take that bet, right? So just even in a short time period for an investor, 1 year, 74% of the time we're positive. On a rolling 3-year period and a rolling 5-year, it's about the same. 84% of the time, the market is positive. And if you look at a 10-year, 92% of the time we're positive. So obviously, if you had money invested in the market and we said 92% of the time you're going to make money, I think we would all be willing to take that bet. And that's really down to even 92% because of what's called the lost decade from 2000 to 2000 and through the end of 2009, because we had the early, call it, tech.com bust in the early 2000s. Then the market recovered up, and then we all know it happened in 07, 08, 09. And so by the end of the decade, the S&P 500 was pretty much flat. But if you look at 98 through 2008, that's a time period where the market's down. So, but again, if you just waited that extra year or two, now we're back to positive. And there hasn't been a rolling 15-year or a rolling 20-year period in our country's history, at least not since 1950, where you've lost a penny in the stock market. So again, time horizons are different for every investor, but unless you're kind of in the end stage of life, we all have a lot longer time horizon than we think. Someone who might be coming up on retirement and is, in their 60s saying, well, Drew, I don't have much time anymore. So if the market takes a dip, I don't have the time I used to recover. And while that, is somewhat true, our time horizon is through the end of our lives. So with people living, well into their 90s, oftentimes these days, that's 3 decades. So time, we all have time for the most part. So time in the market is what makes people money over the long term. And as Evan mentioned earlier, pullbacks are common. On this slide, we're looking at a pullback of 5%. The S&P 500 normally has 5% pullbacks per year. So again, if you were to sell every time you got a little volatility, you're going to miss those up days. In that first slide that I went over, we're going to be missing a lot of the gains that you see in the market. So what's a little interesting is people's risk tolerance in 2021 seemed to be very high. We only had 5% pullback. We've already hit our 3% average so far here in 2022. So again, volatility is the name of the game when it comes to investing in the stock market. And very few of our clients are fully invested in stocks. That's why we want to be diversified. We don't want all of our eggs in one basket. We kind of want to create that garden where we have things blooming at every season of the year. So if we look at a correction, which Ev mentioned earlier is a 10% pullback, you get at least one of those a year. And in fact, he showed us that since 1980, it's been about 14% a year. Now that's, we had big years like 2020 and 2008, where we certainly, saw much bigger than that. But on average, you should expect to see about a 10 to 14% decline every single year. And when we look at where we've been this year, as Evan said, we've hit an intraday bear market of 20%. If we look at where we're at right now, we're down about 14%. So what we've seen this year is maybe a tiny bit more volatile than the average year, but it's really not something that's far too uncommon. And, if we look at a bear market, historically, they happen about every 4 years or so, every 4 to 5 years. So I know we had one in 2020. That was a very unique and kind of an anomaly in terms of how that all played out due to the COVID situation. And I'm going to now kick it back over to Evan to talk about. We've seen some poor starts before. What does it normally mean for the rest of the year when we see a poor start in the first 4 months or so?
Thank you, Drew. Want to make sure, Katie, just one more time, can you pop on? You see a poor start doesn't mean a poor finish.
Yep.
Okay, awesome. So we've really kind of hammered home the fact that volatility is normal, and that if you stick with it, the market does recover. One last example of this is going to be the 10 worst S&P 500 index returns year to date through the end of April. Okay, so you can see 1932 through April, the market was down 28%. You can pick another one here, 1970, it was down 11.4%. This year through April, which was the third one down, 2022, the S&P 500 was down 13.3%. Obviously, we don't know how it's going to finish this year, but you can see how a lot of these other years performed throughout the rest of the year. So May through the rest of the year, many times, about if you see that as percent positive towards the bottom of the slide there, about 2/3 of the time, you're going to see the market be positive the rest of the year from May through the end of December. And some of them pretty significant. 1942, it recovered. It did 27.5% through the rest of the year. We have a 29% in 2020. Again, every year is different, and factors play out a lot differently from each downturn. But again, sticking to it and maintaining a long-term focus. We're going to see how it plays out in 2022. But as Drew mentioned, if you stick with it over time, you're gonna recover and be in better shape. I think that's probably good on the volatility side of things. Something that's really caused and been a driver of volatility this year is going to be interest rates. Okay, and so the next page that we go to, this is the stocks historically perform well when interest rates are rising. Okay, I want to pause there for 1 second and point out that Drew and I have talked a lot about the S&P 500. Okay, so that's the largest 500 companies in the U.S. Talking about the stock market. We have not mentioned bonds. Okay, so I'll mention that here as we get into interest rates, because stock markets have performed relatively well during rising interest rate environments. But on the bond side of things, that's where you get a little bit more of an issue. If you're, a lot of you have met with me before and you've seen me do the teeter-totter. When interest rates are going up, the price of existing bonds tend to go down. Okay, if I own a 5-year bond paying 3%, and new 5-year bonds come out now paying 4%, the bond that I owned is not worth as much. If I wanted to sell it, I have to sell it at a discount. That's the teeter-totter of interest rates and the price of existing bonds. So, and we can answer more of those questions here at the end. This is focused on the stock market again, and this is looking at the 10-year Treasury. Okay, the 10-year Treasury yield, as it has been over time, different time periods. When it goes up, how has the stock market performed? The 10-year Treasury is the most quoted yield when it comes to bonds. Okay, financial institutions, talk about mortgages. a lot of loans are based on what the 10-year Treasury is doing. Okay, we saw, I think, in the month of May that interest rates on 30-year mortgages got into the fives, the mid fives. Okay, the 10-year Treasury has risen this year quite a bit, getting over 3%. For historical context, just 2 years ago in 2020, there was a point when the 10-year Treasury was at 0.7%. So we've seen quite the increase in interest rates as inflation has picked up. In particular, the number one tool the Fed has in its toolbox, and we'll talk about the Fed here in a second, to fight inflation is to increase interest rates. As they increase their federal funds rate, the market follows along. The 10-year Treasury is going to start to increase, and that's what we've seen this year. And when we look at this page, you can see when rates start to rise, when they end rising. If you take the top one there in 1962, where we had a rising rate cycle that was about 45 months long. During that time period, not a big increase, but the 10-year Treasury increased 1.7% during that time period. The S&P was up 18. And you can see throughout kind of how things have performed. A lot of times when interest rates are going up, like I said, bonds don't do as well. A lot of people flock to stocks to try to get better rates of return. And a lot of times when interest rates are rising, not in this economy, but typically when rates are increasing, a lot of times that's because the economy is doing well. That's because maybe the Federal Reserve is increasing rates like they were doing before the pandemic, because they wanted to maintain that balance between growth in the economy and controlling inflation. So a lot of times these are good economic time periods. When we look at towards the bottom there, the average duration, the length of an increase in interest rate cycle is about 2 years. The average increase around 3%. The average S&P 500 return over a time period around 18. Okay, and again at the bottom, this is pretty much in line with what we've seen with a lot of different slides, is that the stock market 70–80% of the time is going to be positive. All right, let's go to the next page. We're talking more about the Federal Reserve. Stock returns during Fed rate hikes. This is what's caused a lot of the volatility this year. When we come into January and inflation's not transitory, and we see that it's going to be here for a while, we see a 7% number on the consumer price index, 7.5, 8, 8.5, 8.3. We see inflation sticking around and staying high. The Fed is going to have to increase interest rates. And when they do that, historically, how has the market performed? Well, this is the slide that gives you some of that context. Okay, you can see the first rate hike, the last rate hike, what the federal funds rate started at. The federal funds rate this rate cycle started at 0. Okay, ending the Fed funds rate, what is at when they stop the rate hikes, the number of hikes, the rate of return during that cycle, and the annualized return. Okay, this year in March, the Federal Reserve increased interest rates for the first time. That first increase was 0.25%. They did another one at 0.5%. And the idea or the expectation in the market is that they're going to continue to do rate hikes, probably another 7 to 8. The next one will be another 0.5% is what the market's pricing in. If they go off schedule there, again, that's another reason for the market to add some volatility, to say, hey, we were anticipating 0.5% and you did 75 basis points. That, again, the market likes certainty, and if they don't get it, that's where some volatility comes in. That's what we saw to start the year. When you look at this, during the annual returns during rate cycles, going up about 4% on average, 5.5% the median. Again, 72% of the time it's going to be higher. So if we take a look at this, I know that some folks are going to chime in about the last time we saw inflation like this. You can see in the 70s and 80s different rate cycles and what the Fed did from 77 to 80. Okay, they increased the federal funds rate from 6.25% to 21%. The S&P actually was positive during that time period. Okay, earlier in the 70s, the S&P was negative. So again, different time periods, different results. But we can take more questions on the Fed and increasing interest rates here. The idea is that the Federal Reserve wants to have what they call, quote unquote, a soft landing for the economy, to where they don't raise interest rates too fast to slow the economy down too much to where we go into a recession. It's a tough act, but they're going to try to settle us in where we can get inflation under control. Hopefully the labor force participation rate increases, which takes some pressure off of corporations in terms of wages. And then you also have supply chain issues. A lot of things kind of have to fall into place for the Fed to create that soft landing. But that's what they're doing with the Fed rate cycle going up on the federal funds rate. And we'll see how it plays out. But this historically is how the stock market's performed. All right, last thing from me, and then I'll kick it back over to Drew. The other piece that is playing into the markets, along with inflation, interest rates, all that else is going on in the economy, is going to be geopolitical events. Russia invades Ukraine on February 24th of this year. That has obviously thrown the market, another tough thing to deal with when it comes to price of oil going up even more than it already was. You have fertilizer, grain, a lot of agriculture stuff in that part of the world that is generated. So in terms of commodity prices, I think that the Russia and Ukraine event has really had an impact there. We don't know how that's going to play out. Hopefully there's a ceasefire and that conflict comes to an end. But no, that's anybody's guess. You can look through here and see different geopolitical events and how things have played out. And when you talk about, let's just pick one here, 2017, the bombing of Syria, that was on April 7th, 2017. You can see the total drawdown on that one was 1%. Took 7 days to get to the bottom, 18 days to recover what was lost there. There's obviously some bigger ones. Iraq invasion of Kuwait, that took 189 days to recover. So the geopolitical piece is such a wild card that is thrown the market. Each is going to be a little bit different. If we keep that long-term focus in mind, we always get through these as well. But this is obviously something that we're watching very closely. And I think especially when you have a military conflict, we all hope it comes to an end sooner rather than later. All right, I'm going to kick it back over to Drew. 4 more slides, and then we'll answer some questions.
All right, thank you again, Evan. We should be looking at the average bear, so please let me know if that's not on the screen. So we've talked a lot about market volatility, obviously, and we've mentioned a bear market a few times. So we think it makes sense to put what have bear markets brought us historically to give us a little bit of context, to maybe place some proper expectations should we see another one. So what we have here on the screen are the bear markets that we've seen, going back here since the mid 50s. And when it comes from the duration, that's meaning, okay, from when we hit our peak to how long it took to hit our bottom, and then what the magnitude of those declines were. And again, we know that definitionally, a bear market is a 20% drop from a high. And then how long did it take the market to recover in those periods? And then we'll talk about what the impact of a recession during a bear market tends to have on the length and the recovery time. So, you name it, we've got all the bear markets here. On average, the decline period is about 11%, or I'm sorry, about 11 months. So if we think about when we hit our high currently, we're looking at, I believe it was January 3rd. I think it was the first trading day of the year. We hit our high, and we've gone down since. And by the way, back to the last slide that Evan mentioned, we saw that during these geopolitical events, the market's down about 6%. Since the invasion on the 24th, the market's down about 4% currently. So the bulk of this year's declines happened before the Russia-Ukraine situation even happened, and it's certainly added challenges, but just wanted to mention that as well. And if we have no recession, we're looking at about 6.5 months of a recovery time. If we do have a recession, we're looking at about 15.5 months, or I'm sorry, not recovery time, of the duration of the decline. So we're through May now. That's about 5 months of kind of a sustained decline where we haven't recovered losses yet. So we believe that a lot of what's going to drive things going forward will be the health of the economy, which really means the health of the consumer. And then that bleeds into the health of corporate profits, because if people are still spending, corporate profits are going to remain strong. If not, corporate profits take a hit. And as we saw, the market tends to go pretty much in lockstep with what corporate earnings are. So what's the magnitude of the decline on average? A bear market is about 30% drop, 23% if we don't have a recession, 37% if we do have a recession. So again, you can kind of see that the market is going to be volatile at times, but if it's volatile during a recession, those tend to sting and last a little bit longer. And then time to recover, the average is about 19 months. So, you add the average decline period of about 11 months to the time to recover of about 19. We're looking at 30 months. So call it 2.5 years to fully recover from the time that we hit a high to our bear market and recover all of it. And again, for most of us, we keep that long-term perspective. That presents us with a lot of opportunities, quite honestly, especially if we're still in our working years and are able to save into those kind of markets. But also, if you're diversified, like Evan showed, the decline isn't as bad and the recovery tends to be quicker. So almost all of our clients are very well diversified. So the sting isn't as bad on the downside, and the recovery tends to happen much quicker. If we do see a recession, it takes a touch over 2 years typically to recover the losses of about 37% on average. But if there is no recession, it takes about 10 months. So if we don't enter into a recession, we're looking at about, call it 16, 17 months from the time we hit our high to the time we get back to that high. If we do hit a recession on average, we're looking at about 42 months, so call it 3.5 years or so. So that's not necessarily the rule, right? There's been recessions where it's recovered much faster if the recession's mild, and a lot of this is skewed due to the big ones like 2008, and then the recession in the 70s as well. There was, as we can see there, a pretty long recovery time on that one. So, and then the dot-com bubble, that was nearly a 3-year bear market. So it's going to vary bear market to bear market, but ultimately we just want to provide a little bit of context. It's not fun. We definitely don't want to see a 3-year recovery period, but at the end of the day, for most of us, that's not certainly anything that's going to eat into a 30, 40, 50-year time horizon in the grand scheme of things. And we thought it was very important to kind of give you a look at what the average midterm election year is. So, this is not getting into the politics of 2022. We'd be here all week. But what does the average midterm election year tend to give us? Well, as we can see here, we pretty much float around, plus or minus 1 or 2% all the way until October. Once we start to get a little bit of certainty, then the market says, okay, we know what kind of direction we're heading in, and then we can kind of resume business and get on with our lives. And then the market generally ends pretty strong into the end of the year. Now, midterm election cycles, the party who's not holding the presidential office tends to win. And what does that mean? That means we get good old gridlock in DC. And gridlock pretty much provides certainty for the market. They know that one side or the other is not going to get it all that much done. And so the market can focus on fundamentals and really what are companies earning and are we going to go higher or lower from there. So, coming into this year, we thought it would probably be a volatile year, throw on some economic and geopolitical issues on top of that. It's been exacerbated a little bit, but, just from a typical midterm election year, we generally see kind of a flat line until we start to get a clear direction on what's going to happen there in fall. And then once the election hits, then we typically see nice gains. All right, what do we think here at Traction Financial Partners is going to drive the market moving forward? Kind of the four primary things are company earnings, inflation, consumer spending, and interest rates, and they're all pretty well intertwined. Corporate earnings, as Evan showed us earlier, they were very strong. And so, again, that's kind of looking in the rear view mirror. But at the end of the day, the market was down in the first quarter while corporate earnings were strong. The market is always forward looking, however. So as Evan mentioned, some of the guidance that some of the companies have been giving, they're certainly not saying we're going to stop making money. They're just saying we may not make as much as you had forecast earlier in the year. So we'll see if that comes to fruition or not. On average, as we saw, companies tend to beat earning estimates at a clip of about 70 to 80%. So even with this guidance of maybe not being quite as rosy of a picture as it was coming into the year, if they're able to beat those expectations, the market tends to like that. And when we look at inflation, I think that's the hot topic, right? In our country, maybe not all of us on this webinar, but in this country, I believe it's around 60 to 65% live paycheck to paycheck. So inflation really means an awful lot to them. And coming into this year, the January reading was about 7.5% year over year CPI. 8.5% was our peak in April, and then the most recent reading from, what was in March, the most recent reading from April was about 8.3. So it remains very elevated for around 40-year highs. So that's going to drive a lot of things moving forward. Are we going to start to see these inflation issues ease over time? That's really going to be a boon for consumers, or is it going to stick around and put strains on budgets? And that's going to lead directly into consumer spending. So when we think of GDP, the gross domestic product for the country, 70% of that is made up from consumer spending. So it is quite clearly the most important ingredient for economic growth. In the first quarter, we saw negative GDP of 1.5%. They just came out with a revised number a week or so ago. However, consumer spending was up 3.7% in the first quarter. So while we see a negative GDP number, a lot of that's due to imports and exports and government spending dropping coming off of COVID and things like that. Maybe not dropping as much as we might like, but nonetheless, those factors drug it lower. But the most important component of consumer spending was positive at about 3.5%, 3.7%. So the consumer remains strong in the first quarter. We're going to keep a very close eye on whether or not that persists, or again, is inflation going to start making people think twice on some of these discretionary spending items. And then last but certainly not least is interest rates, which Evan did a good job of walking us through earlier. At the beginning of the year, the 10-year Treasury was about 1.5%. This morning, around 2.9. So it reached 3.2% at one point. So while historically that's still a pretty low figure, essentially doubling in 5 months, That's a pretty big move, and that's why the 10-year bleeds over into a lot of other interest rates. It's very closely tied in with mortgage rates, which Evan showed us or mentioned that we got into the mid fives. It's eased a little bit here in, call it, the recent few weeks, but we're going to see what wins out. If the economy remains strong, yet inflation's still running hot, we'd expect interest rates to go higher as the Fed continues to hike and things like that, because that's really the way to tighten and slow down the economy from overheating where inflation just can't be controlled. But if we start to see the economy falter in a more meaningful way and maybe recession fears start to become more prominent, we might see that number come down, and then that'll be a nice ballast, at least for diversified investors, where the bonds can kind of hold up their end of the bargain and provide a smoother ride if we see any volatility as a result in the stock market. Evan mentioned the federal funds rate. We started this year at essentially zero. We're currently in the 0.75% to 1% range, and the Fed is, as we see continued hikes. Evan mentioned the next hike is pretty much telegraphed at this point to be another 0.5%, and the one after that, that's the expectation as well. So we might be close to 2% here in the next few months at a federal funds rate, and then they expect to slow down their hikes at that point. But I think a lot of that remains to be seen, because again, what's going to win out? Is it going to be inflation, or is the economy going to be slowing enough to where they pump the brakes? And there's a saying in the market, don't fight the Fed. If the Fed is being accommodative, the market loves that, and the market tends to go higher. So even though we're seeing pretty big interest rate hikes from the Fed, 2% historically is still pretty darn low. I believe the long-term average is closer to about 4%. So we're going to keep a close eye on the 10-year Treasury and the federal funds rate. And, I just mentioned down here as well, mortgage rates have gone up a good 2% or so this year. So what can we do at this time? I know we're running pretty long, so I might go through this relatively quickly so that we can get to any questions that you may have. Kind of the premise of our entire presentation. We want to maintain that long-term focus, and let's revisit our financial plan. If we don't have a financial plan and we want to know what kind of impact this market volatility is having, it'll be important to create a financial plan. So we want to keep our eye on the long term. When we're building financial plans and using a Monte Carlo simulation, it's accounting for years like this quite often. Really strong years, really poor years. So these bear markets that we know inevitably as investors we're going to see, our planning software is accounting for that, and it can give us a good idea of whether or not we're still on track. But let's make opportunity out of some of these lower prices. If anyone has cash, we all know the name of the game is buy low. It's hard to do emotionally, pretty easy to think about it in practice, to think about it as a general idea, but in practice, it's a little harder because, okay, things are bad. It's a little harder to invest money right now, but that's ultimately what allows you to make good profits moving forward. If you have extra cash that you want to invest and you don't feel comfortable dumping it all into the market, let's consider dollar cost averaging, tiptoeing our way in systematically, maybe on a monthly basis. Roth conversions. For a lot of our clients, part of their financial plans is doing a Roth conversion, taking their IRA money, that's pre-tax, converting it to a Roth IRA so that we create that tax-free pool of money. When the markets are down, it's a really good time to do it because you can convert money when, again, the markets are low, and then when the markets recover, we're kind of supercharging that tax-free Roth portion of the portfolio. Last, if you have taxable or non-retirement accounts, tax loss harvesting. What is tax loss harvesting? That means we're going to intentionally sell securities that are at a loss so that we can book it on paper. Then we immediately move the proceeds into a similar investment. There's IRS tax laws. You can't just immediately buy back what you just sold. It has to be different enough to be accepted by the IRS. But we can still put it into a similar investment to where we ultimately recover. But we have that tax loss on paper, which can offset future gains. If you don't have any gains to offset in a given year, the IRS lets you take 3,000 of that as a deduction, and these losses carry forward with you forever. We all know property values have been very high. If you sold a property at a big gain in your investment portfolio, generating some capital losses can go a long way to offset that, so you can keep more of those proceeds. So those are some of the opportunistic things that we can look to at this time. And with that, that will wrap up our presentation. And we'll kind of slide over together here. If you have any questions, feel free to throw them into the chat. We'll give it a few minutes. I do believe we have one question at this point. Evan, what is a better economic indicator, the S&P or the Dow?
We like to follow the S&P 500. That's 500 stocks versus the Dow, which is 30. Just for comparative purposes, the S&P, like Drew said earlier, is down around 14%. I believe the Dow went down about 9.5%. So when we look at different sectors of the economy, financials, tech stocks, healthcare, all that's incorporated into the S&P 500. And the Dow is just not quite that diversified. The news media likes to quote the Dow. But it's a bigger number. Hey, the Dow lost 500 points today, or it was up, 600, whatever it might be. That's typically what you hear when you follow the news when they reference the market. But we tend to look at the S&P 500 because it does a better job of representing the overall economy. If there's any other questions, go ahead and type them into the chat. Hopefully we covered a lot of those questions along the way. I know we went through a lot of information. The theme was, focused on the long term, as you probably heard us say many times. As we go through markets, economic conditions like this, it's very important to make sure that we have that long-term mindset. And also, like Drew mentioned, from a financial planning perspective, to call us and be like, hey, how does our account now play into our distribution strategy once we retire? Or how do we now adjust spending if we need to? Whatever it might be, we like to take a planning approach and tie that to your portfolios, understanding how best to allocate those given your goals and your priorities. So always make sure that we're ask us questions anytime you have them during these time periods. We want to make sure we're doing more of these webinars along the way here, and we're going to send out communications, market updates, just short little video clips as well. So you'll be hearing a lot from us throughout the year. If you have any questions, please feel to reach out. It looks like I think we're good on the question front. So it's 10:03. We went a little bit long, but hopefully that was valuable for you. And I think we will wrap it up there. Again, if you have any questions or comments, please feel free to reach out to us.
And thank you so much for your time this morning. We know it's very valuable, so we appreciate you spending some time with us. And with that, we'll go ahead and shut things down and keep your eye out for the recording of this coming out here soon. Thank you so much.